Thank you for joining us. I'm George Feiger, Chief Executive Officer of Contango Capital Advisors, an affiliate of Zions Direct. Today, we're introducing a video version of Heard Off the Street, our weekly newsletter examining economic and financial conditions around the world. I'm here with Perry Piazza, Director of Investment Strategy at Contango. Perry, let's start by talking about the stimulus package.
Yeah, let's jump right in. George, you're unhappy with the way the Fed and the Treasury have gone about economic stimulus. Do you agree with the Tea Party's argument that big government's just getting bigger and that they're harming the economy with what they're doing?
I have, Perry, a very different complaint. The Tea Party and everybody else talks about what's good for the economy and what's bad for the economy, and the assumption is that whatever it is, we should be doing what's good for the economy. My problem is that there isn't one economy. There are different groups of people in very different situations in our economy, and what the Fed and the Treasury have been doing has been harming one group in an attempt to benefit another group.
Okay, so the issue is not what the Fed and the Treasury are doing, trying to help the economy, but essentially how they're going about doing it. By lowering interest rates to near zero, you're contending that there's this massive redistribution of wealth going on, from savers to borrowers. Savers aren't earning anything on their savings, yet borrowers are benefiting by these low interest rates. Is that basically your point?
Fundamentally, that's my point. There is a massive redistribution, and people who are retired or near retired are finding their income has fallen and they're essentially dining at the Roadkill Cafe. And the worst part about this, in addition to all of the personal disasters, is that the single biggest borrower in our economy is the federal government itself. So one way to think of this transfer is as a giant tax that people don't even understand is taking place.
That's interesting. And this redistribution you're talking about, it's already going on, correct? Savers are earning near zero on the interest on their savings, yet they're expected to live off of this. So retirees and near retirees are going to have a much lower standard of living potentially, and also potentially dip into the principal of their savings that they might not have had to do in a higher interest rate environment. So this redistribution is probably going on already. Are there any other sectors or types of investors that are being affected by this redistribution of wealth?
Yes. As you say, the most tangible things that are happening are the people who are living on interest now. Their income has shrunk. But think about the people who are expecting to retire, are near retirement, people who are expecting to get a payout from a corporate pension plan, people who have an annuity and think that this annuity is going to pay out income for the rest of their lives. What do you think stands behind these pension plans, stands behind these annuities, right? The pension plan has purchased bonds. The insurance company that's paying the annuity has purchased bonds. And these are the bonds with these very low coupons. So our assumption is that a number of these organizations, these pension plans, may find they actually run out of money and in effect default. Indeed, it's possible that some smaller life insurance companies might also run out of money or have too little to meet all the obligations on their annuities. And then there's a further level. When you talk about whether a corporate pension plan is adequately funded or not, what you're really doing is discounting future obligations.
Right.
When interest rates are low, of course, the discount rate is low, and so these future obligations are bigger.
Right.
So in the current environment, as you've observed, Perry, more and more of these pension plans are finding they're seriously underfunded. And what that means is that regulatory pressures make these companies put money into the pension plans, and this is money that's taken out of investments in the ongoing business. So you see, you have these second and third level effects, which are also extremely important and limit the welfare of retirees in the future, beyond the effect, as you say, on people right now.
That's very interesting. So this series of events, this series of the Fed's lowering of interest rates is really sucking potentially productive money out of the economy and into these pension plans. And when the money goes into these pension plans, it's being invested at these ultra low rates. So there are unintended consequences of all this monetary stimulus, I guess is the point. And the other point, the logical extension of that, is that many of these pension plans, many of these corporations that offer pension plans are stopping offering pension plans to new employees because it's just not worth their while to do it. So more and more of these employees are being shifted into 401k plans. What's the implication of that?
When you look at what people do with a 401k plan, you see two things which are not very happy for the future. First, people save too little. And secondly, what they do have, they tend to invest not very wisely. So in all of these different ways, we fear that this redistribution is going to be harming retirees for years to come.
Okay. So I understand most of your gripes. There's this redistribution of wealth from savers to borrowers. There's a lot of unintended consequences. But don't lower interest rates and more fiscal stimulus actually help the economy? Aren't we adding more jobs currently in this environment? And isn't that unambiguously good for the economy?
That's my fundamental point. Good for whom? You don't make everybody better off in this process. In fact, I would characterize it as follows. We are, in effect, telling Granny to go without lunch so that some kid who hasn't finished high school can finally get a job flipping burgers. Have we made this choice consciously politically? What do you think, Perry? Do you think that we have actually made a choice like this politically?
I think it's an important political discussion to have because, as you say, there's this redistribution going on, hurting savers, helping burger flippers and borrowers, and is the rising tide lifting all boats? The answer is probably not. And I think the issue is going to become more important because right now you've got this big bulge of near retirees, the baby boom generation. So they're going to be retiring soon, and they're going to face the same conundrum as the current pool of savers. Low interest rates, this distorted economic situation. And all studies and all statistics show that this bulge of near retirees haven't saved enough. What are they going to do? How do we solve this problem of this huge bulge of near retirees not having saved enough?
It would be nice, Perry, if I had an answer to this question. I think the real issue we're trying to publicize in this discussion is that everybody should be thinking about these issues. Thank you, Perry. Thank you for joining us. Thank all of you. I hope you found this discussion useful. If you have an interest in these topics or other financial issues, contact us. Visit our website at contangoadvisors.com. Give us a call, send us an email. We always look forward to hearing from you.